Welcome to Commercial Real Estate Consulting Group. Today, we will be talking about cap rate. What is cap rate? Cap rate, short for capitalization rate, is a real estate term that measures the rate of return on a real estate investment property. The cap rate is calculated by dividing the property's net operating income, NOI, by its market value or purchase price. The resulting percentage represents the rate of return an investor can expect to receive on their investment if they were to pay cash for the property. For example, if a property's NOI is $100,000 per year and its market value or purchase price is $1 million, the cap rate would be calculated as follows. Cap rate equals NOI, property value, x 100%. Cap rate equals $100,000 per $1 million, x 100%. Cap rate equals 10%. In this example, the property's cap rate is 10%, which means that the investor can expect to earn a 10% return on their investment each year. Cap rates can vary widely depending on the type of property, location, and market conditions. Generally, a higher cap rate indicates a higher return on investment, but also a higher level of risk. Conversely, a lower cap rate indicates a lower return on investment, but a lower level of risk. Investors use cap rates to compare the potential returns of different investment properties and make informed investment decisions. For more information about commercial real estate, book now and talk to our expert team.